Receive $1 million. Don't simply retire from something, have something to retire to. Harry Emerson Frosting. Reaching for the light. In his award-winning book, The Trees in My Forest, Bernd Heinrich describes how trees in his part of the Maine woods individually manage their growth and resources to compete for light. The choices are simple. They can take the nutrients they absorb and focus their growth upward or focus it outward. To reach the light, some trees attempt to be taller than those around them. Think of the tall forest pines that are mostly bare except at the highest reaches. Those trees are racing upward for the light. Other trees grow wide in hopes of drowning competitors in their shadows, like an oak spreading out in a clearing. Last is the curious case of running ground pines that sprout up wherever the light pokes down through the upper canopy. An opportunist like this can have a root system the size of a football and is often mistaken for many separate plants. Each tree in its own way manages growth upward or outward or some combination of the two to strive, thrive, and reach for light. The journey of the millionaire real estate investor is no different. On the path from buy $1 million to own $1 million, investors must manage their primary resources of cash flow and equity to reach their net worth goals. Some choose to apply cash flow to paying down debt and therefore accelerate their equity buildup. Others tap into their equity or save their cash flow to reinvest in other properties. A few take the cash flow as it comes, leaving their equity where it is and let time do its thing. None is right or wrong. These are different paths to the same goal of increased net worth. Now it's time to turn our focus from net worth growth to annual unearned income growth. Receive $1 million is founded on the idea that you can, if you choose, reach a place in your investment life where you can step out of the day-to-day work of investing and receive $1 million in annual pre-tax income. It's about amassing the capital assets that can provide you with that kind of unearned income. It's not about knowing the ways to convert those. It's about amassing the capital assets that can provide you with that kind of unearned income. It's about knowing the ways to convert those capital assets to cash flow. And it's about building an organization that ensures that your money will continue to work for you even when you are no longer working for your money. That's one of the big questions we want you to be able to answer, the ultimate destination we want you to strive for. We know that if you can reason a path to that big income goal, you can learn how to step out of your investment business someday and receive more unearned income than many would ever dream of need. $1 million in annual unearned income. The challenge of unearned income. One of the things I've found to be almost universally true is that most people do not know what it takes to generate meaningful amounts of unearned income. Before you can invest money, you generally have to earn it and pay taxes on it. Only then are you able to take your net income and invest a portion of it for a passive return. If you were working at a job to earn $1 million in annual after-tax net income, you'd have to earn over $1.5 million to compensate for taxes. Think about it. Today, the highest tax rate for ordinary earned income is 35%. That means you'd have to earn $1,538,461 to net an even $1 million. That's 1 year of amazing earnings that goes away the moment you stop working. Investing for $1 million isn't much easier, and it takes a lot of after-tax income to generate $1 million in interest. The chart below tells the story. Working from left to right, you can trace the amount of income you'd have to earn before taxes to have enough money left over to invest after. The chart below tells the story. Working from left to right, you can trace the amount of income you'd have to earn before taxes to have enough money left to invest after taxes to reach your big income goal. If you could achieve 5% annual interest on your investment, you'd have to earn over $30.7 million to net the after-tax $20 million you'll need to invest to receive $1 million in pre-tax income. At a 10% annual rate of return, you'd still have to earn over $15.3 million to invest $10 million after taxes to receive $1 million in cash flow. Even at a 15% annual rate of return, an investor would have to earn over $10.2 million to invest $6.6 million and reach his or her passive income goal. Honestly, it doesn't have to be this difficult. Receiving $1 million in annual income is very possible with real estate. It can be comparatively easy for those who are willing to think, buy, and own like millionaire real estate investors and put their money to work for them over time. Let's take a closer look at what it takes to receive $1 million in annual pre-tax income from investments in real estate. Achieve $1 million in annual cash flow through investing in real estate. The interesting thing about investing in real estate is that you have many options for achieving your big income goal. As one of our millionaire investors put it, there are many roads to Rome. For the purposes of this discussion, let's narrow our focus to single-family residential investment homes and attack the issue from 4 distinct angles. 1. How much real estate would an investor need to acquire today to receive $1 million in annual cash flow now? 2. How much real estate would an investor need to acquire today to receive $1 million in annual cash flow in the future? 3. How much real estate would an investor need to acquire over time to receive $1 million in annual cash flow in the future? And 4. How much real estate would an investor need to acquire over time to receive $1 million in annual cash flow and equity pull out in the future? In all 4 models, we'll work with the understanding that an average single-family home costs about $170,000 with a gross monthly rent of $1,360, based on our conservative 0.8% of market value formula. To account for vacancy and other expenses, we used a conservative figure of 40% for our calculations, and where appropriate, we used mortgage interest rates of 6.97% for 15-year loans and 7.43% for 30-year loans. Rent and the value of our properties will appreciate at 5% annually, which is slightly below historical averages. Finally, we'll work from the assumption that the properties are acquired at a 20% investor's discount with a 20% down payment. Don't forget that your choices and your abilities can improve the results with all these models. If you choose to reinvest cash flow to acquire more real estate or pay down debt, you may achieve your goals faster. If you consistently achieve higher rent rates, lower your expenses, or reduce your vacancies, you'll be accelerated along the path to your net income goal. With that in mind, let's look at the first way to receive $1 million in real estate. Make sure you understand what you want your portfolio to look like at the end. My future portfolio will be 250 houses. If all paid off, that would be $1.4 million in annual gross rental income, and when I'm 60 or 65, I can sell them and hold the notes. You want to get to a point where you have a business. Marshall Redder, Millionaire Real Estate Investor, Granville, Michigan. Number 1. How much real estate would an investor need to acquire today to receive $1 million in annual cash flow now? To receive $1 million in annual pre-tax income now, an investor would need to acquire 102 single-family rentals at once and own them free and clear. Anything less than a 100% equity position requires a substantial increase in property ownership as well as a greater investment of cash. For instance, if an investor chooses to close with 50% down payments, he or she will have to acquire more than 240 homes for a total investment of over $16.3 million. As illustrated in the chart below, to achieve this goal immediately, an investor needs to invest $13.8 million to gain a 100% equity position in the properties and save $3.5 million by acquiring properties at a 20% discount. Achieving $1 million in cash flow today requires a substantial upfront investment. The good news is that most people don't need to receive $1 million immediately. Most people have at least some time to let the advantages of investing in real estate work in their favor. Number 2, how much real estate would an investor need to acquire today to receive $1 million in annual cash flow in the future? Factoring for time works in an investor's favor because it allows the investor to account for appreciation in real estate values and rents, both of which historically tend to appreciate at around 5% a year. Using the same assumptions, by this time including our regular 20% down payment for 15-year, 30-year mortgages, let's examine how much real estate an investor would have to acquire today to achieve $1 million in unearned income in 10, 20, or 30 years. This time, we'll allow our hypothetical investor to let the market forces work in his or her favor. The chart below depicts 6 different scenarios which this could play out. 3 are for 15-year mortgages and 3 are for 30-year mortgages. Pick a quadrant that matches your timeline and take a moment to consider the numbers. In this model, the numbers take an astounding turn to the investor's advantage. With a 10-year window, the investor would need to invest $6.9 million with 15-year mortgages or $3.9 million with 30-year mortgages to achieve $1 million in pre-tax income. With a 20-year window, the investor would have to invest just under $1 million with 15-year mortgages or $1.5 million with 30-year mortgages. Finally, given a 30-year time frame, one would need to invest between $595,000 and $768,000. All these scenarios produce strong and in some cases remarkable rates of return on investment that would satisfy most millionaire real estate investors. What keeps this scenario in the realm of the hypothetical for most individuals is the necessity of buying all those properties in just 1 year. Let's look at our third model, where the investor can purchase properties over time to achieve $1 million in unearned income in the future. Number 3, how much real estate would an investor need to acquire over time to receive $1 million in annual cash flow in the future? In this model, we'll factor for both time in the market and time it takes to acquire the portfolio of a cash flow millionaire. What's instructive about this model is that it shows investors the average number and market value of the homes they will have to buy each year to meet their unearned income goal. Furthermore, it shows the amount of money an investor will have to invest on average each year, a key driver in setting one's budgeting and savings goals. Again, the model, see the chart on the facing page, depicts 6 scenarios that are based on the mortgage loan selected and the time frame. Take a moment to review each scenario and the numbers they represent. What immediately jumps off the page in this analysis is the growth of net cash flow over time. In the 10-year scenario, there is a marked benefit to choosing the increased cash flow of the 30-year mortgage, 17.1 homes purchased each year, over the equity buildup of the 15-year mortgage, 39.9 homes purchased each year. In fact, the investor's acquisitions are more than cut in half. However, this is reversed once the 15-year mortgage has been paid off in the 20-year and 30-year scenarios. If you're looking for cash flow and have time to grow it, accelerated debt paydown may get you there faster and with fewer overall acquisitions. Number 4, how much real estate would an investor need to acquire over time to receive $1 million in annual cash flow and equity pull-out in the future? In the last and most comprehensive model, we're going to accelerate the process by factoring in the fact that equity buildup can be used as a source of income. As you know, there are 2 ways to achieve income from investment real estate. Investors can receive cash flow from their investments. Second, they have the additional option of tapping into and pulling out their equity buildup. Equity buildup, the combination of value appreciation and debt paydown, is very real. In fact, until the mortgage debt is completely paid off, there will be greater average annual returns from equity buildup than from cash flow in almost any scenario. As we discussed in Own a Million, millionaire real estate investors who are in the growth phase of their investing always manage their return on equity to keep their money working hard for them. Thus, they rarely look for a 100% equity position in their properties, much less their portfolios. Our research and experience shows that the best, most prudent investor will manage this to range from a minimum of 20% to a maximum of around 70% before pulling some equity out. In the beginning, equity pullout is often used for reinvestment in more property to accelerate the process. The beautiful thing about equity pulled out periodically through refinancing is that this equity income is tax-free. The IRS sees this income for what it is, a liability incurred. These investors count on appreciation and their tenants to pay down their debt and build up their equity so that they can repeat this process. This equity pullout can be periodic or all at once, with the primary considerations being the investor's desired ratio of equity to debt and the cost of refinancing. However, anytime an investor reaches the $20 million equity mark and is achieving at least 5% annual appreciation, that investor is in effect getting $1 million a year in tax-free income if he or she chooses to pull it out. In all the scenarios of this 4th and final model, the investor buys fewer properties and invests less to reach his or her net income goal. As the time frame of the investment plans lengthens, the investor has the extra bonus of having to lead generate for fewer and fewer genuinely great investment prospects each year. In fact, in the 30-year scenario, the investor must find an average of only 1 outstanding property every 2 years. Whether your goals are for today, 10 years from now, 20 years from now, or even 30 years in the future, we hope you're motivated to do your own math. It's about asking the $1 million unearned income question in a personal way. Will your criteria allow you to buy for less and achieve more? How will the real estate and rental values in your market affect your personal equation? Where's your comfort level with your leverage? Do you want to keep a high equity position in your properties for security, Or would you prefer a lower one for greater rates of return? One of the things we discussed in Own a Million was the concept that millionaire investors think in units. Interestingly, when you apply the powerful leverage of trading up to larger multifamily investment properties to this equation, 1 million in unearned annual income becomes far more approachable. As we've learned, by consolidating property management and leasing into fewer properties, investors can lay claim to higher rental rates than the 0.8% we've considered for single-family rentals while having fewer management issues to deal with. In fact, one of the investors we interviewed built an amazing investment business by buying and selling real estate for investment income and then reinvesting in larger multifamily and commercial properties that now generate $12 million in annual profits. That, by the way, is $1 million a month. $1 million a month, the inspirational story of Investor 34. One of my favorite stories is that of a millionaire investor we interviewed in California who built a remarkable real estate investment business that generates $12 million in annual profits. Since he was our 34th interview, and out of respect for his wish to remain anonymous, we'll call him Investor 34. Investor 34 started his investment business on savings and credit cards, and for the first 6 months, he and his wife worked from the kitchen table. By that measure, his success should feel repeatable to most people. He didn't have the advantage of beginning his investment career with large sums of money. The niche he latched onto was buying limited partnership interests in real estate. He and his wife would obtain lists of the limited partners from the general partners, which by law they were required to share, and then mail those investors a marketing piece offering to buy their interest. At the time, they would offer as little as $50 for shares that were valued at about $100, and roughly 5% of the people they mailed to would take them up on their offer. But then a rising tide in the California real estate market swept them up and helped them turn as much as $150 in profit on each share they acquired. As this investor said, our goal is not to be the biggest company around, it's to be the most profitable. So we would rather do a lot of small transactions that are highly profitable than a big transaction that generates the same amount of net income. Their business success was limited by how much time they could devote to the mailings. A big breakthrough came when this investor's wife called the printer and asked, "Can you print, address, and stuff these for us?" All of a sudden, they went from mailing 1,000 marketing pieces a month to 5,000, and then 10,000, 20,000, and 30,000. Our response rates and our profit margins were the same whether we mailed 1,000 or 100,000, he told us, so the profitability of the company went up. Rather than treat the money as income and consume it, they reinvested it directly in real estate, apartment buildings, and storage facilities, to build a stable platform of residual income. Today, Investor 34 owns over 4,000 apartment units and more than 1 million square feet of storage rentals. Amazingly, he nets over $12 million annually from $45 million in gross revenues. His little investment business has grown into a big investment business, obviously more than he and his wife could maintain at their kitchen table. Currently, he has over 60 direct employees divided among 5 investment companies and another 100 independent contractors who manage his apartment buildings. What I love about Investor 34's story isn't that he built his multi-million-dollar investment business so cleverly in little increments of $100 and $150 reinvested in real estate. It's that he discovered a powerful way to take him farther while working less. People leverage. It really wasn't about the money, he told us. I wanted to set my own schedule, and mostly I wanted to be able to spend more time with my family. Investor 34 works about 20 hours a week. He doesn't carry a cell phone or a pager because I want to be connected when I want to be connected. He spends more and more time with his family. In our language, Investor 34 is well on the path of receive $1 million. In fact, he's at a point on the path where it's possible to receive $1 million a month. But no matter what amount of unearned income he receives at the end of his journey, be it more or less, I know he's already discovering the amazing freedoms that come when you can step out of your daily investment business without losing your income. It's what we call the 7th level, the path to people leverage. The 7th level, the path to people leverage. If you're like Investor 34 or any of the other millionaire real estate investors we interviewed, you'll find as your investment business grows, you will rely increasingly on others to perform the day-to-day tasks of investing while you manage the process. This is the natural evolution of growing a business. One day you'll discover that you're doing all you can and look for help. Sometime later, you'll realize that even with the help, you're hitting a ceiling of achievement because there are more opportunities than you have time to explore. You'll seek more help and continue to grow, and the cycle will repeat as your investment business expands along with your mastery of it. In our observations and experience, there will be 7 distinct and separate levels you will pass through on the path to becoming a Receive a Million millionaire real estate investor. We made the mistake of assuming the more properties we bought, the easier it would be to have positive cash flow. We kept thinking we're making $200 a month per unit. We get enough of those and it's got to equal positive cash flow. The problem with that is you've got somebody to manage them, and as you grow, you've got to add more people. Anna Mills, Millionaire Real Estate Investor, Toledo, Ohio. Although the exact organizational makeup of your investing operation may vary slightly, the 7th and final level of investment business is sure to include one commonality. One day you'll remove yourself from the routine daily business and allow a pre-selected, highly qualified individual or individuals to run your investment business for you. It's the place where you get to enjoy the financial wealth you've built without having to manage it actively. There are 3 basic components to the investment business of a millionaire real estate investor. There will be one part of your business dedicated to acquisition and disposition, one committed to administration, and one that handles your operations. In the beginning, you will run all 3 departments and either do all the work yourself or manage independent contractors from your work network who do these functions for you. But over time, as your investment portfolio grows and you increasingly rely on your work network, you will see the wisdom in hiring an employee to do these jobs for you and only you. Let's take a quick look at the 3 areas of your investment business. The first area, acquisitions and dispositions, is the last one you will give up. A&D is the work of generating leads, evaluating opportunities, and doing deals. This is the heart of your investment business. Without leads, there are no opportunities. Without opportunities, there are no deals. And without deals, there is no income. It's that simple. You'll want to stay active in A&D for as long as you can. This is where you will earn the most money for your time, and so it makes good financial sense to spend the most time there. Administration, admin, is another story. This is the very first area we advise you to relinquish. The admin part of your investment business is the part that handles your legal and financial work, organizes your contracts and closing, and maintains your database and files. The more clerical in nature the work is, the sooner you may find yourself willing to farm it out to your work network and later hire someone to tackle these tasks for you. Interestingly, while some of these tasks fall under the broad title of admin, many are highly specialized. For example, unless you happen to be an accountant or lawyer by profession, you're probably best served not to advise yourself on complex tax or legal issues. You should contract this work out to qualified professionals in your work network. However, you may find that it saves you money to pay for the advice of these professionals and then file your own tax returns with the IRS or record the minutes of the investment business meetings you keep for your legal entities. The last area is ops, and it covers the broad area from leasing and property management to maintenance and construction. Whether you, someone in your network, or someone you hire does these tasks, you probably will have to develop expertise in these areas to become a millionaire real estate investor. Since these tasks are tied directly to your vacancies and expenses, leasing and property management can have a big impact on your bottom line. When we discussed maximizing your NOI in Own a Million, we were pointing you towards the moment when you might hire contractors or employers to do this work on your behalf. Maintenance and construction are similar in that strong knowledge in these areas can both save and make you lots of money. The good news is that your continued work in A&D, particularly the estimation of repair costs for your acquisitions, will help keep you abreast of standard costs in these areas. For many investors, a property manager is the first non-admin employee they hire. Arguably, other than a full-time A&D person, no other position will save you as much time and energy. The moment you contract with or hire a property manager is the moment you cease to function as a full-time managing landlord. This means someone else is taking the call for the broken toilet, the wobbly ceiling fan, or the broken furnace. Someone else is collecting rents and calling past dues. Someone else is freeing you up in a massive way to pursue A&D and build your business. As you can see in the chart above, the investors we interviewed first made the important decision to stop doing it themselves and hire part or full-time administrative help. Every business has a certain amount of work, filing, record-keeping, organization, and errands that can be ignored for periods of time but not forgotten. At some point, those tasks must be done for your business to stay on track, and they can steal valuable lead generation time from critical A&D work. That's why admin help almost always comes first. A highly focused investor probably can generate enough admin work to keep more than one person busy while the investor pursues opportunities and deals. If the first level is where you do everything, then the second level and the third level are where admin employees help you do more. The fourth level is really about bringing in a property manager. In our research and experience, that's almost always the first person hired for ops. A few of our investors chose a maintenance employee first, but those instances were rare and usually were the result of a larger multifamily ownership. The fifth and sixth levels represent your growing investment business and with ever increasing needs for admin and ops employees, and one significant addition, your first A&D hire. This is a person who gets at the game of investing. It may be someone from within your organization or your network who seems to have a knack for finding opportunities or doing deals. You will want to find a fair way to compensate this person, whether it be through base salary, bonuses, or percentage splits, for doing this for you full time. The final and most important stage is the seventh level, where you hand over the day-to-day operations of your investment business to another person. Up to this point, as your organization grew, you were acting not only as the owner and the principal investor, but also the company's CEO. It's now time to hire a CEO to replace you. But this time, the people in your organization with the gift of leadership should be revealing themselves to you. It's likely that one person already is largely responsible for your admin functions and manages the other employees in that area for you. Similarly, another person probably is in charge of your ops. If multiple employees have joined you in your ongoing A&D efforts, it's possible that a leader is emerging in that area as well. Remember, A&D is the last area you should relinquish, and so it is just as likely that you are still providing primary daily leadership and accountability for your company's A&D. These talented individuals have demonstrated that they are committed to the goals of your investment business and have risen to leadership positions within it. You still manage them, but they skillfully manage many people and projects on your behalf. These emerging leaders probably will be the best candidates to slide into the role of CEO. The sobering truth about this transition is twofold. For one thing, no one will be able to do everything you do as well as you do, especially in the beginning. After all, you spent years perfecting your investment models and the systems used to manage your investment business. You know your models so well and are so good at implementing them because they most likely were built to match your natural strengths and compensate for your natural weaknesses. The talented individuals you've hired were brought in to complement, not replace your skills. You can expect your CEO to stumble and struggle a bit in the beginning. You won't be freed right away, but most likely you will have to manage and mentor your CEO until both of you are confident that the person can do the job without supervision or safety nets. That's the sobering truth number one. Sobering truth number two is that your new CEO probably will be much better at some aspects of the job than you ever were. This is where you'll have to rein in the natural competitiveness that helped you build your investment business in the first place. Because your CEO brings new strengths to the position, he or she may earn the right over time to change and even improve some of your systems. Your new role as business owner will be to monitor that person's progression from duplicating the success you created to being allowed to tinker with it. Remember, you built your investment business on proven models. You should expect your CEO to do the same thing. The interesting thing about building a real estate investment business is that you have two distinct choices. On the one hand, you can build a large, active business as Investor 34 did. On the other hand, you can choose to hire sparingly and count on your extensive work network for leverage. Both methods are valid. The big difference shows up at the seventh level. There are downsides of being a landlord. The phone ringing when you really don't feel like going and checking on somebody's water heater. But I have someone managing my properties now, so it's mostly headache-free. Carlos Rivero, Millionaire Real Estate Investor, Austin, Texas. Investors who want bona fide businesses tend to be better positioned to step out and count on their unearned income. Businesses are about cash flow and rarely have caps on their growth. They can remain active and agile even when the primary investor steps away. Investors who build their investment enterprises primarily work through their work networks are aiming towards a pseudo seventh level. To fully achieve the seventh level, you will have to hire your replacement. This path never leads to total leverage. Even though, through outside property management, the investor may be far removed from the day-to-day work, he or she will still need to give the investments considerable attention. Those investments won't continue to grow your investment portfolio the way your replacement CEO would. This is really the path of preserving and maintaining wealth. Many of our investors selected this option. With the help of key partners and a property manager, they built a large real estate portfolios that required less and less of their time. They knew how much they needed and didn't mind that their portfolios were unlikely to grow once they turned their attention elsewhere. They achieved a pseudo seventh level with lots of freedom and great rewards. Over time, you'll be able to remove yourself from the day-to-day work of your investment business and focus on managing your CEO and key leaders. Instead of working in your business each day, you'll be able to work on it as little as a few hours a week. If you've ever wondered how entrepreneurs manage to run multiple businesses simultaneously, this explains it. They work on their businesses, managing key leaders, rather than working in the business every day. Moving from managing your time to managing others. Reaching the 7th level will involve an entirely new set of skills for a prospective millionaire investor. Business and management skills. Instead of creating a pro forma system for a transaction, you'll be reviewing one made by someone who works for you. Instead of inspecting real estate, you'll be inspecting reports made by someone who looked at the property for you. The good news is that from the moment you began developing your work network, you are building the foundational skills necessary to make this transition from investor to business owner. That's what you did with every independent contractor you hired to fix your property, file your taxes, or manage a renovation. You had to tell them what you expected and then inspect their work to make sure it met your expectations. It's about communicating your standards and then inspecting to make sure you got what you expected. The decision to keep for yourself or assign to others the A&D, admin, and ops functions of your business always lies with where your time and their time are most valuably spent. Not only do you want to stay focused on your most dollar productive activities, you want the talented members of your growing organization to do the same thing. If the bookkeeper who saves you thousands in accounting fees each year could save you tens of thousands as a property manager, or make you even more money scouting for opportunities, you may find yourself looking for a replacement bookkeeper. Choosing whether to contract with this person from your work network or to employ this person outright involves the same financial common sense. The main difference lies in the length of time you pay the person. You engage contractors from job to job, but employees are engaged for the long term. This means you have to have enough work to justify their salaries and keep them engaged. Your progress through the 7 levels is essentially a progression from I do it, we do it, to they do it. In the beginning, you did everything and essentially paid yourself. As you developed your work network, you started contracting with others to leverage your time and profits. The moment your investment business began generating reliable income, those people had the option of bringing in full-time employees to grow it. This is the period where you'll be working with people inside and outside your organization. The 7th level is where you take on the role of business owner and run your business through the talented leaders you've hired. These leaders are the custodians of your investment business, an asset that still pays you money. While you still will bring vision and values and standards to your business, you'll cease to run it on an everyday basis. That's the gift of the 7th level business, owning an investment business asset that pays you unearned income while demanding a comparatively small amount of your time. 'Tis better to give than to receive. Moving from wealth. Accumulation to wealth distribution. In late December 2004, Businessweek published its annual list of the top 50 philanthropists for the year. On one end of the spectrum were Microsoft's Bill and Melinda Gates, who donated an astounding $10 billion to charity, a one-year gift equal to 20% of their total net worth. On the other end was Martha Ingram of Ingram Industries, who gave away 30% of her net worth for a total of $116 million in charitable giving. The generosity of these individuals was inspiring and instructive. Clearly, those wealth builders understood that it is, as they say, better to give than to receive. That money is good for the good it can do. What they understood is that in order to give $1 million, you first must receive it. One of the greatest gifts of wealth building is the ability to share your wealth you've built. Eli Broad of K&B Holmes said that the reason he gave over $1.3 billion to charity in 2004 was I've always been interested in making a difference, and I think that in just about all of our giving, the money is making a difference. Fortunately, the gift of great giving is available to all. Many top givers credited their fortunes to what we believe is the most attainable and accessible wealth building vehicle around: real estate. My personal wealth building journey and careful observation of others have helped me understand that there are clear financial stages to a person's life: wealth education, wealth accumulation, wealth protection, and wealth distribution. It's not that complicated if you take a moment to consider it. After all, we all have to learn about wealth building in order to do it. Once we've accumulated wealth, it's only natural to want to protect what we have worked so hard to earn. The last stage is the one that is overlooked most often, and time when, having secured our future, we look to help others. For some people, wealth distribution happens in the form of a will. For others, it's about sharing their good fortune earlier so they can see the gifts in action. Whether you choose to distribute your wealth at the end of your journey or along the way, I encourage you to internalize one important fact. Financial wealth is never truly owned. The most one can achieve is to be a good steward for a time and then to pass it on. Philanthropy is defined as the giving and sharing of time, talent, or treasure intended for the common good. It is our hope that as you progress through the 4 stages of this book, think a million, buy a million, own a million, and receive a million, you'll be striving to achieve your personal financial potential as well as your philanthropic potential. Building wealth is as wonderful and rewarding a journey, but it's even better when the wealth is shared. As you consider the time when you can truly receive a million, I hope you'll choose to receive more than you need and share what you don't. The journey to receive a million ends where you decide to end it. You can reach for 1 million or more or less. Your personal goals are your own. We encourage you to use big models designed for more than you think you'll ever want or need. Never put caps on your financial potential. Your potential to buy, own, receive, and even give all the wealth you could imagine. Points to remember. You can, if you choose, reach a place in your investment life where you can step out of day-to-day work of investing and receive 1 million annual pre-tax income. When you can step out of the daily investment business without losing your income, you've reached the 7th level, the path to people leverage. Your investment business will have 3 basic components: acquisition and disposition, administration, and operations. As your business grows, you will hire talent in these areas and over time increasingly hand over day-to-day operations to those you recognize have the gift of leadership. The transition towards removing yourself from day-to-day business can be tricky. When you eventually hire a CEO to replace you, you must manage and mentor him or her until you are both confident the job can be done without supervision or safety nets. Accept that your new CEO will bring new strengths to the role and will likely earn the right over time to change and improve your systems. Understand that reaching the 7th level means using new skills. You will employ business and management skills as you move from I do it to we do it to they do it. As you move from wealth accumulation to wealth distribution, strive not only for personal financial potential, but also to reach your philanthropic potential. Remember, money is good for the good it can do.